Watch carefully because in this video, I'm about to reveal 7 shocking secrets the financial industry doesn't want you to know. I'll be exposing the shady practices and the ugly truth that your financial advisor, insurance broker, and banker are all hiding from you in an industry that is designed to make money from you, not for you. Armed with this knowledge, you'll be able to take better control of your money and claim back hundreds of thousands of dollars into your pockets. You'll learn to flip the script and even beat the vast majority of financial professionals at their own game. Starting with the first secret they don't want you to know, which is the vast majority of financial professionals, including financial advisors, wealth managers, and insurance consultants, are just sales brokers in disguise. They make hefty commissions by selling you expensive financial products that are infested with hidden fees. These products include mutual funds, whole life insurance, long-term saving plans, structured notes, and other complex financial products that are designed to make money from you, not necessarily for you. Some of these products lock you in for the long term with a hefty exit penalty and pay the broker an upfront commission of about 18 months worth of your initial contributions. Did you ever wonder why you don't get anything back if you cancel your plan in the first couple of years? That's right, because the money is already gone paying for your advisor's commission. This is not to say that all advisors are evil. They're just selling what they've been trained to sell, and they're incentivized to promote whichever product pays them the highest commission. With this undeniable conflict of interests, even the best-intentioned advisors are working in the confines of a system that is rigged against the investor, which is you and me. Remember, these brokers work for the house, and as the saying goes, the house always wins. Oh, and about these hidden fees, we're gonna pull back the curtain and reveal their ugly nature with our next secret. Fees associated with most investment products destroy nearly 2/3 of your investments over time. The problem is you never get to know how much you're really losing in fees until you do the math. Moreover, your advisor rarely discloses, if ever, all these fees. Even if you belong to the 1% of the population that actually reads 50 pages of terms and conditions, the fees that are supposedly disclosed in these cryptic documents don't tell the full story, because there are other hidden fees you don't get to see or even know about. For example, this table shows the average annual costs, both disclosed and hidden, associated with a typical mutual fund in the US. Yeah, but these are for US mutual funds. We don't pay that much outside the US, do we? Well, I have some bad news for you. Most investors outside the US pay more in fees. Much more. For example, in the Middle East, the annual fees associated with saving plans and insurance-linked schemes typically exceed 4%. But what's the big deal about paying 4% in fees to have your money managed professionally? It's more like a waiter's tip. That's what I initially thought when I had not just one, but 3 of these saving plans from big-name insurance companies. I know, I was totally naive back then. However, when you pay 4.5% in annual fees and assuming an average market return of 8%, your actual returns will drop to a meager 3.5%. And that's the undeniable truth of simple arithmetic. But wait, it gets much worse with time. So let me illustrate this with an example because again, math doesn't lie. When you invest $500 per month for 35 years, you're supposed to end up with well over $1 million, assuming an average long-term return of 8%. But when you pay 4.5% in fees, you'll only end up with roughly $400,000. This huge difference has evaporated in fees over the years. So you invested your hard-earned money, took all the risk, and ended up with just a fraction of the returns. But aren't investment professionals supposed to get better returns that justify the extra fees we're paying? Well, let me unveil another sad truth that the financial industry doesn't want you to know. The vast majority of investment professionals consistently fail to outperform the broad market over the long term. When paying for professional advice in general, you expect to get expertise and good results. Unfortunately, this is oftentimes not the case with the financial industry. When you typically hand your money over to a financial firm, you expect it to generate good returns. After all, the typical fund manager is leading a group of financial analysts, economists, and professional traders. They have their finger on the pulse of the economy and a flair for investment opportunities and future market trends. So they are seemingly better suited to pick the best investment for you. Or are they? Actually, the facts suggest otherwise. The S&P Indices versus Active, or SPIVA, measures the performance of professionally managed funds against their relevant benchmarks worldwide. These results are published semi-annually in the SPIVA scorecards for several global markets. These reports have shown time and again that the vast majority of actively managed funds fail to match, let alone beat, their benchmark index for any given period. I'll include all these links in the description box for you guys to check them out. What makes things worse is the more you stretch the time frame, the more these funds underperform their benchmark. For example, over the last 20 years, more than 96% of actively managed funds failed to match their benchmark. And what about the 4% that managed to outperform? Shouldn't we invest in them? Well, not so fast. The SPIVA persistence scorecards are another set of regular publications that measure the consistency of a fund's performance over time. These reports show that the outperformance of a very few outliers is pretty much short-lived. So the few funds that have been yesterday's winners will most certainly be tomorrow's losers. This phenomenon is called reversion to the mean, which is a fancy way of saying that high flyers will ultimately revert to mediocrity. Therefore, picking funds based on their past performance is just like trying to win the lottery using last week's winning numbers. So please remember this the next time a financial advisor tries to impress you with the stellar performance of his funds. This is why it's always best to invest in an unmanaged low-cost index fund that simply tracks the broad market. And if you don't know what index funds are, don't worry because I have another video for you after you finish watching this one. The next secret they're hiding from you is about market forecasts and predictions, where economists, financial analysts, and the media get it wrong all the time. The financial industry sells the illusion that if you follow the economy, trends, and financial news, you'll gain a competitive edge in the market, so you'll feel compelled to subscribe to these financial news services. Analysts and market strategists from big-name investment banks and the financial media keep on making predictions about the stock market, inflation, or interest rates as if they have a crystal ball. Now sure, every once in a while, someone eventually gets it right. And when that happens, he or she is proclaimed a seer and gathers even more media coverage. But the truth is, no one can predict the financial markets in the short term. And he's an example to prove it. Nouriel Roubini is an economist that became famous after he predicted the financial crisis of 2008. His predictions have earned him the nickname of Dr. Doom. But what most people don't realize though is that he made the same prediction in 2004, 2005, 2006, 2007, until he finally got it right and became famous in 2008. And to add insult to injury, he also advised people to stay out of the stock market in April 2009, right when the market started its amazing recovery at the dawn of the longest market rally. Moreover, in 2010, he warned that the crisis was not over just yet and that stocks will fall by another 20%. And again, in 2011, he warned of another global recession, which didn't happen either. So, would you imagine how your investments would have performed if you had listened to these predictions? And I'm definitely not picking on Dr. Roubini here. He has a PhD in international economics from Harvard, so his IQ definitely runs circles around mine. But there are also prominent financial analysts and economists that made similar incorrect predictions over and over again. What I'm trying to say is that even smart and knowledgeable people are unable to make accurate predictions about the financial markets. And this is why most people who attempt to outsmart the market will eventually fail, as we're gonna see in the next secret. But before we continue, if you're getting value out of this video, let me know by hitting that like button on YouTube, because I'm on a mission to spread financial literacy and the simple rules of wealth we should have all learned in school. No one should be left behind or taken advantage of by the financial industry. So help me spread awareness by sharing this video with your friends, family, or colleagues. Now back to our video. Secret number 5. Active trading is a loser's game. Many investors believe in their ability to outsmart the market by actively trading stocks or other securities. This is further encouraged by the financial industry, which benefits from the commissions generated by all these transactions. Active traders hope to make profits by buying what they believe will go up and selling what they believe will go down. The problem is no one can predict with any degree of accuracy how stocks, bonds, commodities, sectors, or even funds will behave in the short term. The reality is, empirical evidence proves that active trading loses to buying and holding index funds over the long term. In the 2000 paper, Trading is Hazardous to Your Wealth, published in the Journal of Finance, researchers analyzed the performance of more than 66,000 traders. The paper concluded that the more you trade, the less you make. These results weren't surprising at all, because like we've seen earlier, even the best money managers cannot beat the broad market over the long term. So if these full-time professionals with their arsenal of resources can't consistently beat the market over the long term, do you really believe that you and I know something that these guys don't? Secret number 6. No one can accurately time the market with any level of consistency. Another way some investors try to beat the market is by market timing, which refers to attempting to predict the future direction of the market, typically through the use of indicators or economic data, and then either buying or selling based on that information at the optimal time. This is another mirage, but unfortunately, the financial industry promotes it nonetheless because, again, it benefits from it. And we know by now that economists and other market forecasters cannot accurately predict short-term market moves, let alone the timing of these moves. Moreover, to time the market profitably, you need not just one, but two accurate predictions. When to buy, ideally at the lowest point, and then again, when to sell, ideally at the highest point. So good luck with that. Empirical evidence has shown time and again that it's impossible to do so consistently over an investment lifetime, because the odds are heavily stacked against you. Therefore, attempting to beat the market, either by active trading or by market timing, is a loser's game. Although these tactics have been proven to be a fool's errand, a lot of investors would never stop trying. Why? Because again, the financial industry makes it look so compelling, but also, unfortunately in this case, because hope springs eternal. So again, be wise and don't fall for these traps by understanding this best-kept secret of the financial industry. There's a simpler, cheaper, and more profitable way to invest and grow your wealth for the long term, and the financial industry doesn't want you to know anything about it. If active trading and trying to time the market don't work, and if by handing your money over to financial professionals, you're giving away 2/3 of your lifetime investments, what's the viable alternative? And that is to invest in low-cost index funds. And no, this is neither hard nor complicated. And if I could do it with zero prior knowledge in finance or investing, then anyone else can. And this is coming from someone so bad with numbers that he struggles when it comes to splitting a simple restaurant bill. So here's all you need to do. Open an investment account, transfer some money there, buy a couple of broadly diversified low-cost index funds or ETFs. After that, just continue adding money monthly or whenever possible, and I promise you, you will end up with more money than you ever thought possible. The best part? You get to keep your fortune instead of losing a huge portion of it in fees. And if it still looks complicated, I got you covered because I'm gonna show you how anyone could get started with this simple investment approach. So go ahead now and click or tap this video card and I'll see you there. Or click or tap this card for another video. Remember to subscribe for more videos like this one. Thanks for watching and I'll catch you in the next one.